Hello and welcome to The Explainer. I am absolutely thrilled to have you here today. Look, if you're the kind of focused learner who loves taking dense, complex regulatory filings and breaking them down into clear, actionable insights, well, you're in the exact right place. Today we're unpacking the audited FY25-26 financial results for Interarch Building Solutions. But we aren't just looking at past numbers here. We're tracking a fascinating corporate journey, from massive top-line revenue growth and strict compliance navigation, all the way to a crucial, game-changing strategic shift into the North American market. We're going to dig into exactly how Interarch is putting its capital to work.
Okay, let's dive into this. Here is our roadmap for today's explainer. First up, FY26 financial highlights. Then, assessing governance and compliance, tracking the IPO capital, rewarding the shareholders, and finally, we'll wrap up with expanding into North America.
Section 1, FY26 financial highlights. We're going to use a simple what so what now framework today. And this right here, this is the what.
We have to start with the raw financial numbers because understanding the sheer scale of operations over the last fiscal year really sets the baseline for everything else this company is attempting to do. So for the fiscal year ending March 31, 2026, Interarch posted a massive total income of 192,662.65 lakhs. I mean, wow, that is a commanding top-line performance. Just to put that into perspective, their audited total income for the previous year, FY25, was roughly 147,447 lakhs. The crucial takeaway here is that we're looking at significant, sustained growth in their core revenue from operations and other income streams. It's serious momentum.
But, top-line revenue is just vanity if it doesn't actually translate to the bottom line, right? Well, it absolutely did. We see a really solid jump in profit for the year. They moved from roughly 10,782 lakhs in FY25 up to over 13,452 lakhs in net profit for FY26. That is a very healthy margin expansion. It's a clear indicator that their operational scaling isn't just getting bigger, it's highly profitable. And you can clearly see the logic and flow between that revenue and profit when we look at the middle metric, total expenses. Yes, expenses absolutely grew, from roughly 133,177 lakhs to over 173,838 lakhs. That was driven heavily by raw materials and erection charges. But because the total income so powerfully outpaced that expense growth, the ultimate profit for the year still expanded beautifully.
Moving right along to Section 2, assessing governance and compliance. This is the so what phase of our explainer.
Strong numbers are great, absolutely, but they need a bedrock of good governance to be trusted in the first place. So let's look at the operational realities. Note 8 of their filing addresses a specific interaction with the Income Tax Department. Between August 18th and 22nd, 2025, a search and survey was conducted under Sections 132 and 133A of the Income Tax Act. Following that, in January 2026, the company received a notice requiring a revised return. They navigated this swiftly, successfully filing their block assessment return, which is essentially a consolidated tax filing covering a specific block of years, on February 26, 2026. What you really should take away from this timeline is the management's explicit note that business continued without disruption, and, as of the date of the report, no formal tax demands have been raised against the company. To balance that compliance timeline, the company officially declared a crucial piece of information. Their statutory auditors, S.R. Bat-Laboy & Co. LLP, issued their audit reports with an unmodified opinion. Now, in the auditing world, that is essentially a flawless report card. It literally means the financial statements are presented fairly and appropriately. This provides tremendous reassurance to the market regarding the accuracy of those fantastic FY26 results we were just looking at. Further strengthening their governance framework, the board took proactive steps by reappointing two major auditing firms for the upcoming 2026-27 financial year. They secured BDO India LLP, which is part of a massive global network of 119,000 professionals, as their internal auditors. Plus, they reappointed JSN & Co., who bring highly specialized expertise in cost compliance, as their cost auditors. It's a very strong signal that they are maintaining rigorous internal oversight moving forward.
Section 3, tracking the IPO capital. Let's talk about allocation.
This brings us to a frankly crucial question for any investor. How exactly is the company utilizing its IPO capital? I mean, it's one thing to raise money. It's another entirely to deploy it effectively. The raw figure we're tracking here is 18,809,079 lakhs. That's the total net amount available from the IPO proceeds after deducting the offer expenses. Our job right now is to see where every single rupee of this capital was allocated up to March 31st, 2026.
The data here tells a fantastic story of capital allocation. The bulk of the money went exactly where it fuels growth. 5,500 lakhs went straight into incremental working capital, and over 4,869 lakhs went toward general corporate purposes. But check out those next two allocations. Significant chunks of capital are driving hard asset upgrades. Over 2,250 lakhs directed toward upgrading manufacturing facilities in Kicha, Tamil Nadu, and Pantnagar, plus another 1,829 lakhs for new project setups. They are quite literally physically expanding their capacity to match their revenue growth.
And the bigger picture brilliantly illustrates that out of the total net proceeds, a massive 15,888.49 lakhs, or roughly 84%, has been fully utilized. The remaining 2,921.30 lakhs isn't just sitting around collecting dust, though. The filings confirm this capital is safely parked, primarily in temporary fixed deposits, ready to be deployed the second the next strategic phase requires it.
Section 4, rewarding the shareholders. So, we've seen record profits, we've seen responsible capital allocation. How is this strong FY26 performance directly benefiting the backers? Well, the board of directors has enthusiastically recommended a final dividend of Rs 12.50 per equity share for the 2025-26 financial year. Since the face value of the shares is just Rs 10, that represents a jaw-dropping 125% dividend. That is a highly tangible reward for shareholders, and it's an incredible display of the board's confidence in the company's cash flow and future stability. Which leads us perfectly into Section 5, expanding into North America. This is the now what of our framework. Having completely secured their domestic base, Interarch is embarking on a bold strategic future beyond India's borders. Now, what's really interesting here is that they've officially disclosed a brand new international partnership, securing approvals to enter into memorandums of understanding with Steel Inc., based out of British Columbia, Canada. Steel is already an established player in North America's structural and pre-engineered steel buildings market.
But they aren't just signing one generic handshake agreement. They are actually executing a two-pronged strategy. Let's look at the difference. MOU 1 is a strategic collaboration focused purely on business development and sales growth for pre-engineered buildings in Canada, so there's no fixed financial or equity arrangement there yet. However, MOU 2, that is much deeper. It proposes a formal 50-50 equity joint venture specifically for the exploration and development of the open web steel joists, or OWSJ business. Let's connect the dots on why this strategy is so smart. The synergy is just brilliant. The plan is to leverage Steel's deeply rooted local market access and customer relationships over in North America, while utilizing Interarch's highly cost-efficient, scalable engineering and manufacturing capabilities back in India. It creates this powerful export growth platform. Notably, they've also explicitly agreed to avoid direct competition in sensitive sectors like mining, which ensures the partnership remains entirely complementary, not adversarial.
We've seen the incredible revenue growth, the clean governance, the smart IPO utilization, and the generous dividends of FY26. But as we wrap up this explainer, I want to leave you with a provocative thought. How will this bold 50-50 North American joint venture reshape Interarch's financial trajectory in FY27? Will combining Indian manufacturing efficiency with Canadian market presence be the exact catalyst for their next massive leap in scale? I don't know about you, but I am incredibly eager to track their next earnings report to find out. Thank you so much for learning with me today, and I'll catch you in the next explainer.